Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, March 7th, 5:01 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Unfortunately, the caution is back in the state of the market as Powell testified on Capitol Hill today. His opening statement immediately sent stocks lower as he talked about higher rates for longer and frankly quicker. And the Fed funds futures market started to price in an increased chance of 50 basis points at the next Fed meeting coming up in a couple of weeks. And in fact, it's up to 70% now, which is certainly not beneficial if you're a stock investor. So state of the market back to uptrend with caution. You can see over here in the trend gauge. If you looked at the 21 over 21, you wouldn't even think the market did a whole lot today, as 17 of the 21 uh, were only 17 of the 21 were down less than the S&P 500. Seven of them positive, in fact. So leaders still holding up pretty well. But as we know, if the market continues lower, it'll get the leaders too. So we don't just invest in leaders in a vacuum. We need to take a look at the big picture, and that includes what bonds and the dollar are doing. Short term neutral. I mean, we were ready to go to bullish uptrend after the nice bounce off the 200-day moving average last Thursday and the follow through strength on Friday. Gap up yesterday, negative reversal, and opened flat today, but a big negative, very red day. So we're actually headed back more towards bearish on 21, as all five of the major indexes got their first close below the 21. The NASDAQ 100 basically sitting right on it, but the other four indexes with one close below. We'll see what tomorrow brings. We normally want two closes and then either a lower low or a higher high before we make the commitment to either bearish or bullish. Medium term got a little bit worse today. Also, the Dow firmly rejected at the 50-day, and the S&P 500. If you're looking at the SPY or the IVV or the VOO or the SPLG, you're basically closed right on the 50-day. If you look at the S&P 500, you're slightly below it. So uh, let's call it still an uptrend. One close right on the 50-day for the S&P. And long term neutral, all five indexes still above it, but the slopes of the line struggling to get turned in the right direction, with the exception of mid caps. So what just happened today? As I said, hawkish Powell scares stocks lower. The final numbers are not pretty. G6 down 1.1. Ironically, with rates, it was only the shorter term rates that really rose today. In fact, the TLT was up, which means the longer term rates were down. The 10-year basically flat. And growth stocks actually outperformed value stocks. G6 down 1.1%, S&P down 1.5, NASDAQ down 1.2, Dow down 1.7, mid caps down 1.2, Russell down 1.1, global diversified 60/40 stock and bond down 0.98, global bond down, but barely down. In-house GROTECTION down 1.03%, which is a minor win considering the exposure we came into the day with. But our index longs hurt us. Our overall holdings and positions helped. So down 2/3 of what the S&P was. We'll hit the tail of the tape and charts of interest momentarily, but first let's get to the S&P 500. We'll talk about what we do here at Revere Active Management. We determine how much capital should be allocated to the market by the action of the five major indexes versus three key trend lines. Short term using the 21-day, medium term using the 50-day, and long term using the 200-day moving average. We get especially defensive if we get below the 200-day moving average because all bear markets occur under the 200-day moving average, including COVID, including last January to October after a nice recovery off of COVID. So once we get under the 200-day, we really ratchet up the defense and protect capital. If we're above it and leading stocks are acting well, we'll have various levels of money into the market. For example, at the beginning of the day yesterday, we had about 1.2% going home today with under a percent. So 2 days cutting quite a bit of exposure here, and leading stocks holding up, as I said, pretty well. Didn't cut any of our holdings, just reduced our index exposure with the hard break below the 21 and the close below the 50 by 0.2% here. Let's look at SPY so we get the exact number here. SPY basically right on it, a penny off of it here. So that's why we don't just go by one close below, because honestly, what happens the last couple of seconds can be a lot of manipulation anyway. But uh, this is what the defense. It's what we play when we're under the 200-day. We're not there yet, but we have rules, and when we're under the 21, we don't want to have exposure more than the risk of the S&P 500 on board. We'll talk about that when we get to the tail of the tape. So what type of market are we in now? Coming off of the bear market, just shy of the severe bear market. We had the early recovery, which transitioned into an early bull, had a mild pullback, met to a mild correction, which is 4 to 8% off the high. We rallied, got back to mild pullback, less than 4% off the high, but back now to this mild correction. Our performance is basically going to be in line, somewhere around 60-40, sometimes somewhere around near what the S&P was doing, but we're going to keep our exposure. With the market not being a strong bull market, we keep our exposure basically in line with near the risk of the S&P. So here's the SPY. Let's go to the S&P and we'll look intraday, and it's pretty clear when this statement came out right here. Tight first 30 minutes, then harsh move down, rebound, another move down, rebound, another move down, rebound, selling off into the close. Basically, lower lows, lower highs constitute a trend down. It was a choppy trend down day, but it was a trend down day nonetheless. Back to the daily chart, you can see 2 days above the 21 and 2 days above the 8. Now our first day back below the 21 and the 8, and our first day below the 50 or on the 50. But still 1.2% above the flat 200-day moving average. Let's go to the NASDAQ 100, which has been outperforming and outperformed the S&P today, sitting right on the 21-day. Note relative strength continues to go higher. The sectors that were down today, when we checked the tail of the tape, XLK down less than the S&P. It was financials, banks, real estate, base metals that really took the beating today. But you can see the hook down here. Also, after coming off of oversold, we got looked like we had a nice trend going, but a pause the last 2 days. We'll see what tomorrow brings. As I said, we limit our exposure depending on what the market is doing and leading stocks are doing. Dow Jones Industrial Average hooked down also. You can see the failure into the 50-day, down 1.7% today, back below the 21, back below the 8. Mid caps, which had been leading, didn't lead yesterday. Minor outperformance today, holding the 50-day moving average, one close below the 21. IWM small caps, big underperformance yesterday, bounced back a little bit today and held the 50-day moving average, but again back below the 21-day and back to an unfavorable stochastic there also. Equal weighted indexes basically did just as bad as their market cap brethren today. The biggest move and the biggest overhang on stocks was the dollar. which gapped up. Then when Powell came out, raising interest rates higher for longer means a stronger dollar. You can see the trend higher, complete opposite of what was going on in the market. This pretty much drove the action in the market today. Let's go to the daily, making a higher high also, and a move above the 200-day moving average, where it hadn't been since the beginning of last December. So the trend with the strong dollar, we had the setup coming off of overbought, but hooking back up today, big disappointment for the bulls. Let's go to interest rates now, and we'll start off. They're not all in the same direction today. TLT was up 0.61%. This corresponds to TYX, the 30-year yield, which was down. Uh, Conversely, the IEF, this is the 10-year ETF, was just barely positive. So let's look at the TNX, the 10-year bond, down zero point 0.2, not much of a change at all. The 5-year 0FVX up 1.03%. So the 5-year note, you get anything from 2 to 5 really got a pop today, or actually shorter term with including the T-bills to 5 really got a pop today. The ETF for this is IEI. And you can see that that was down on the day. So shorter term rates up, longer term rates down. A mixed bag today. It ended up with the broad bond market being basically flat, down 0.11% on the day. Flip to gold and gold stocks with the strong dollar. You know what's coming, don't you? Yep, gold. Uh, putting the screws to this uh, 4, 5, 6 day rally that we had, down 1.75%. Gold stocks down even worse, 4% again. So we rallied into the declining 21 and failed. Silver SLV, yikes, down 4.5% and making a lower low. Bitcoin down 1.38%, still trading in a tight range, but trending lower overall. Okay, so those are the major charts, indexes that we look at all the time. Let's get to the tail of the tape, uptrend with caution. You can pause it here to read the whole thing. I'll hit the highlights. Uh, Basically, what Powell said was the terminal rate will be likely higher than we anticipated. We may accelerate the pace of interest rate raises. That took the market down, and like I said, 50 basis point hike, up to a 70% probability now. We're jockeying between the bull and the bear case, which is what uptrend with caution means. Uh, the only things up today, retail. Dick's Sporting Goods had a very good day, up over 11%. Jets, also up, and the dollar up very strongly. Uh, the mixed result between bond prices and yields, 11 out of 11 S&P sectors down. The worst of it was banks, gold and silver, real estate, and PIC, the base metal miners. Here are our holdings. What we did today is add to TBT with the initial spike in interest rates. Uh, this was a hedge. It ended up actually lower where we bought it, but well off the lows. That's TBT. And out of the gate, Airbnb extremely strong and outperformed all day. We did significantly trim UPRO to get our adjusted beta down from 1.18 to under a 1, which is, we don't want to be over 1 if we are below the 21 day, especially with the tenuous action of the market and the failed move higher. Bottom line, hawkish Powell talks higher rates and stocks drop hard. Here are the support and resistance levels. Let's take a look at a couple of well, let's run through the entire portfolio. First of all, TBT. We initially bought this yesterday on the bounce off the 21. We added to it after it spiked with the initial Powell comments, but some interesting action here. Initially, all rates were higher than the longer term, and this is the 30-year. The longer term sold off, came down, the yield came down harder, but then into the close, it popped. So as long as this holds the 21, we'll be holding on to this, and that corresponds with the TLT failing into its declining 21 day. moving average. Tesla, uh, very volatile day for Tesla. It rallied strongly in the afternoon, but failed early and failed late. Coming into oversold finally, still hasn't broken below the low of the event day, which is 186.01. Today's low 186.10. But the declining 8 and the 21 are serving as resistance here. Next up, TMDX. This continues to hold up very well. Tight range, down less than 1%. RVNC, Botox competitor, trading tightly, down 0.24%. Airbnb, we have a 4% size in this now. Showed strength early, really showed strength all day, finishing positive, holding on to the ADMA. We'll be quick to trim some of these things that we have 4 or 6% sizes in if they don't maintain their strength or if the most recent buys go underwater. ANET got an upgrade today from Goldman Sachs, outperformed on the day near its highs post gap up and post breakout. We're still in Iridium, which is holding up well, just barely down today, sitting on the 21. Net can't get going. This is our smallest position, sitting right on the 21. Palo Alto, largest position, a 6% size, sitting on the 8 EMA after its earnings gap up. First Solar continues its strength. 5 days higher closes now since its earnings report. Nothing, no stocks are acting the way this one is, or very few, and if they are, they're not liquid enough. And Nvidia, uh, flirting with higher highs since its gap up, but as soon as the market turned south, it turned south. Ended up down by 1.1% today. So that's an entire move through the portfolio. Like I said, we added to TBT. Our net exposure 0.99, basically in line with the S&P 500, and that's where we'll be as long as the S&P is under the 21 and the rest of the indexes continue to struggle. And then the stocks that we own will, their stops, they will basically will be judged on their merit, but with a lean towards being more defensive as this nice bounce off of the 200-day moving average. We've given way, uh, let's see, I've got a set of fib levels here for the NASDAQ 100 and the S&P. This is from the 3-2 undercut and recovery of the 200-day moving average, and then yesterday's highs. So 39.85, we're basically sitting right on the 61.8% retracement, and basically right above the 50% retracement on the NASDAQ 100. These are really as far as you want to go, 61.8% at the most. So we've given up over half of the move off the lows, not the direction we want to go in. So that's going to wrap it. As always, love to hear from you. It's Don at RevereAsset.com. My partner, Dan Stewart, Dan at RevereAsset.com. Phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much you can keep. We've got a plan either way, market going higher, market going sideways, market going lower, based on our time-tested rules. If you're interested in this approach, give us a shout. And with that, I will wrap up Tuesday, March 7th. This is Don Vandenbord, just the facts here at Revere, telling it like it is. The message isn't always good news, but the facts don't lie. Thanks for listening. Have a great day.